last year. So I've got 45 minutes to give you all the details of what I believe is to come this year. We're also going to have a look at exactly what did happen last year. There was, of course, a lot of, as usual, predictions once interest rates started to rise early last year that we would have a housing market crash. Of course, we know that didn't occur. So we'll have a look at exactly what did occur, but also more importantly, we're going to have all the latest data. It is February. I can wish everybody a happy new year, belated, but really it is the beginning of the property year now. And we do have some data, the latest January data, to, I guess, get a real insight, early days, yes, into what is actually happening in the housing market currently and what are the prospects going forward. Of course, we had our first real auction weekend last weekend. We have the results of that tonight as well, and they were somewhat surprising, really, at how robust the market has come back. Early days, but still some very positive signs going forward. So let us commence. We don't want to have too much blather from me early days. It's all about the numbers. This is my brand, the My Housing Market. I act as an independent commentator for a number of clients, of which Positive, of course, is one. And I think if you're a talking head in anything, at least you should have some qualifications. We're not going to talk too much about me. And I do have a number of qualifications in the discipline that I comment on. And it's not just the housing market economics, but it's also that I have some formal research qualifications as well. And I'm also a member of the Royal Institute of Chartered Surveyors, which means I have a discipline skill in measurement. And of course, my measurement is the housing market and the broader economy. I've had a lengthy career as an economist. My last formal role was as chief economist for the Domain Group. But since I left Domain, I've been working as an independent provider of analysis and data going forward. And I also get my head occasionally on the box. So I think the media at least regard me as a bit of a straight shooter. Not apt to provide those crazy headlines that we get about property. But that's enough about me. We want to see what's going to happen in our capital city housing markets, the current state and future prospects. And there they are in all their glory, our great capital city housing markets. And of course, home prices are now set to rise in 2023. And that's everywhere, in my opinion, in those capital city markets. Last year was a year of consolidation and certainly a year of change for particularly the Melbourne and Sydney markets. But that did follow a very strong period of price growth through 2021. So maybe it's that old adage that what goes up comes down again. But certainly our adjustment process last year was all about the winter market. And really markets did start to rebound, particularly Melbourne and Sydney through spring. And that's continued into the new year. When we look at our housing markets, I like to break it down into three fundamentals. Of course, people, and that means migration. And that's very important this year in our housing markets. We are going to see an unprecedented surge in migration into Australia. And the latest news that might even be higher than planned, given that China is now reopening its borders. And news is that encouraging students to again take up their studies overseas. And of course, that's a very important factor for our economy, particularly Melbourne and Sydney. And those students will have to find somewhere to live. But we'll look at migration, an overview of migration shortly. But on the supply side, of course, where are all these migrants going to live? Well, that's the real problem, because we are a chronically undersupplied housing market in Australia. All our capital cities have underbuilt over the last 4, 5, 6 years. So the question is, where are all these migrants going to live? And the old, I guess, the basic fundamental economics of law and supply, the law of supply and demand, is if you don't have enough supply as demand is rising, then prices and rents will rise as well. So, of course, the glue that holds everything together is the economy. And when we talk about the economy, and particularly housing markets, we're talking about interest rates. And of course, tomorrow is the first meeting for the year for the Reserve Bank. I think that the Reserve Bank will again raise rates, but I think the discussion over the direction of rates is becoming not as clear as it has been certainly through last year. So we'll talk about interest rates in a minute. So the economy, interest rates, interest rates certainly generate house price growth. Higher interest rates, of course, mean property becomes less affordable because you have to pay more for your mortgage with a given income. And as rates fall, of course, property becomes more affordable because you can buy more because your interest rate is lower with a given income. So the Reserve Bank sets interest rates nationally, of course. There is no local interest rate. Maybe we should try to arrange that, but it's not going to happen. But what it means, of course, is that every capital city is a hostage to national interest rate movements. But we don't see housing markets or house prices, home prices all move at the same rate. They move basically in the same direction, but those different rates of growth or decline are about local factors. They determine the rate of growth. So let's have a look at the story for interest rates over the modern era. Well, since 2005, you can see that roller coaster journey. In fact, these are mortgage rates, and mortgage rates were as high as 9.5%. In 2008, of course, we're at the back end there of a very strong mining boom. The Reserve Bank put up rates to quell demand. Similar circumstances here with rising inflation at that period. However, the Reserve Bank quickly moved into reverse gear, cutting rates when the GFC, the global financial crisis, hit Australia as it hit everywhere else. So mortgage rates fell down to 5.8%. Australia was lucky. We rebounded with a mining boom. Number two, thank you, China. Exports of iron ore and coal created another very strong economy. And the Reserve Bank stepped in again, pushing up interest rates to 7.8%. But since then, of course, we've had interest rates cut down and down. We had a couple of blips there where interest rates increased. That wasn't the Reserve Bank. It was action by APRA, the bank regulator, to curtail investor activity, which it felt at the time was at a too high level, and that they were concerned if interest rates increased, that would destabilise our housing markets. APRA were wrong. Reserve Bank were wrong then also because they were predicting higher rates. It didn't happen. Rates continued to fall, and of course then came the COVID and rates were cut sharply to stimulate growth in a highly uncertain environment. So current mortgage rates are at 7.3%. I think the rates are perhaps we've seen bank mortgage rates rise a little bit quicker than official rates have increased, but that's a story for another conversation. But the key, of course, to interest rates is how it impacts house prices. You can see there typically higher interest rates, lower house prices, but house prices ease rather than fall when we do have higher interest rates. But when we get lower interest rates, of course, markets take off. And that's because a lot of the underlying demand is curtailed when we do get into a period of higher rates. It's the fear of being involved as buyers and sellers sit on their hands. And of course, once there's some clear air and interest rates fall, all that pent-up demand is released, and that's why we see those very heady results once interest rates fall. And you can see that the top two cycles, Melbourne and Sydney, really, although a roller coaster ride, had some spectacular growth through that lower interest rate period. Brisbane also spectacular growth, particularly in 2021, and that was a result of very significant interstate migration through the COVID lockdown period coming out of those southern states. And Adelaide similarly strong growth, and even Perth was starting to pick up a lot that it had lost through that end of the mining boom period, which really did flatten the Perth housing market. So we can see that relationship between interest rates and house prices. As I said, higher interest rates typically ease house price growth, whereas lower interest rates take advantage of that pent-up demand being released, and we do get very strong growth. When we look at the cycle, and this cycle here is the December quarter data, and you can see quite clearly that the markets are starting to turn. In fact, all those markets now are starting to head to the bottom. The rate of declines have eased, and I think that's a very clear indication of our prospects for this year going forward, is that I think that once we get the March quarter data, we will see most markets having flattened out at least. And I think some of those markets, such as Adelaide and Melbourne, will be starting to record growth again. So I think it's important to look at the cycle that is telling us the direction, the likely direction of our markets going forward, particularly given that we're already seeing signs of price declines leveling out. So the outlook is improving for interest rates. This is the current interest rate scenario. 3.1% are official rates at the moment. The bank will meet tomorrow, likely put up rates 0.25%. That'll bring us to 3.35%. I believe that rates will peak at least around about 4%. So I think 3 more rises in prospect in our current tightening cycle, and that will bring us up to 3.85%. I think we're closing in now on a pause. Outside chance it may be tomorrow, but I think that the Reserve Bank will be more focused on not creating an economic downturn and perhaps managing inflation, and therefore we'll have a period to contemplate the action of interest rate rises over the past 9 to 10 months before it moves again. But that likely won't be tomorrow, but it might be over March, so watch this space. The economy is still booming. This is remarkable, and this is why we haven't recorded a sharp decline in house prices. Unemployment rate still at its lowest point in history. Well, for monthly results anyway, 3.5%. I think the unemployment rate and the labour market has flatlined now. Don't think we're going to get much lower than this, but it's a spectacular economy. Fantastic, for workers. Wages are rising. Plenty of competition amongst employers for available labour. However, inflation is rising. Again, we saw inflation up again over the December quarter. Probably a little concerning to the Reserve Bank, perhaps looking for some easing, but this is underlying inflation. We must remember that the target for the Reserve Bank is 2 to 3%. It's currently running at 6.9%. It will fall away this year because it will be comparing a high period with a high period. That's why our rates are high now, because as you can see, a year ago, they were quite low as we were really moving into our higher inflation period. But I think that it might be some time before we get to that Reserve Bank target of 2 to 3%. And I think perhaps that'll change the outlook or the mindset of the Reserve Bank, and not just Australia's Reserve Bank, but also central banks everywhere. I think maybe starting to think about, well, we just have to live with a little bit higher inflation, maybe a 4 to 5% target or a 3 to 4% target, just to maintain what are very strong economic conditions. Will rates increase tomorrow? Yes, I think they will. That's the outlook. Again, likely increase of 0.25%. And as I said, increased likelihood that rate rises may pause soon. The latest inflation data was a bit of a concern, as I mentioned, because it did reveal that service prices were now rising. And that does reflect that perhaps employers are starting to pass on those higher wage demands or higher wage outcomes to their prices. And that's a concern that we might be moving into a wages prices spiral. So I think the Reserve Bank will be watching that very carefully. Previously, it was only goods prices that were rising, and that was a reflection mainly of the supply constraints that occurred during COVID. I think the labour market may have peaked. It's still a great labour market, let me tell you, but we did see fewer jobs over December, a lower participation rate, still very high participation rate, and that steady jobless rate, but still strong. But I think, the Reserve Bank will be thinking, okay, well, we might have got, we might have reached our peak in terms of what's happening in our labour market. And we did see retail sales plunge over December, which may be of interest to the Reserve Bank because it will show that spending, it did show that spending fell away over December. But really, it was when we're seeing this new seasonal effect with November being higher than December. And a lot of that is the Black Friday impact of November, which is bringing forward a lot of retail spending, which used to peak in December, is now peaking in November. And we saw that in 2021 as well. So it's a mixed bag for the Reserve Bank. Some good news, bad news. But I think the news isn't crystal clear that interest rates are having the impact as yet that the Reserve Bank would like. So I think it's still got a little bit of ammunition there, and it'll go up by 0.25% tomorrow. But I do think that the signs are emerging that we may be coming to the end of the interest rate cycle for the moment. But we've got to really emphasize this is a very fluid environment. There's a lot of uncertainty. Things can come out of left field. We've got the price of oil now down below 80 cents a barrel, $80 US a barrel, which is good news. But these things could change, and the price of oil is a very significant impact, has a very significant impact on inflation if it starts to rise again. So that's our economic overview. Just quickly, as I mentioned before, we're going to have a surge in migrants. That's going to drive housing markets, of course, because they are undersupplied. Where are they going to live? And this is the latest data, which is in some ways a real shock in terms of how strongly migration has rebounded once we moved out of the closed border environment. And you can see there, continuing, the Queensland market is the strongest market for, or the strongest economy for migration. Still well and truly above the other states. Queensland is still a favoured destination. This is net migration. And as I mentioned, there's all these state migrants have to find somewhere to live. And this has been a very strong recovery. The other cycle I'd like to point out is the black cycle there, and that is Melbourne. Melbourne's had a very strong rebound. In fact, it's had the sharpest rebound over the post-lockdown period of any of the states. And you can see there where we track backwards how strong migration is into Melbourne traditionally. And I think the Melbourne market is front and centre, really primed to take advantage of this surge in migration, which will continue. It's a very migrant-friendly destination. And I think that we're already seeing signs of higher rents and higher prices early days in January. And I think that does reflect that migration surge. As I mentioned, supply is on the other side of the equation, and we really have underbuilt over the last 6 or 7 years. These are building approvals, total dwelling building approvals. You can see that trend has eased since the home builder policies of early 21, which created a surge in activity. But the trend is still downwards. We had an upward movement in building approvals over December, and some were, prematurely suggesting that this was a beginning of a building boom of some sorts. It's not, folks, because the home building the surge in December came from a big developments of units. Monthly approvals tend to be quite lumpy because you can get a very big development coming through in a particular month. This is what's happened in December, and that's what's artificially pushed up to some degree the building approval data, because as you can see, when we look at houses, they've underperformed again over December. So early days there to start celebrating a return to more building. I think the long term is we will continue to be constrained by a number of factors, not the least being very high building costs to be able to match supply with demand. And there are a number of other factors that are roadblocks to new developments, such as planning restrictions, and all these scenarios mean that we will continue to be undersupplied going forward, and it will mean we're already seeing a sharp movement towards unit living, based not just on affordability, which is obviously a shorter term factor as demand pushes into units and preference to houses, but also because unit living is becoming a preferred lifestyle as well. And over the year, you can see there that all units and houses are down over the year as well. So the long-term trend, you can see there that we're down around 29% on the annual trend for building approvals for dwellings, which is well below, obviously, where we were back in 2016. And this is a clear measure or model of why we're seeing rents rise, and over the longer term prices will rise, because we just don't have enough houses for our populace. And now that we're back into a more of a reliable and steady environment, fingers crossed, for demand this year, then we'll really start to see the impact of underbuilding over the last 6 or 7 years. And you can see there that it's really units that have declined sharply over that period since 2016. There are a lot of, I mentioned the APRA movement on investors that also impacted developers through that period. And, we're building about half as many units as we did way back in 2015 and 16. And now we're confronting a surge in migration and a reviving housing markets. Where are they going to live? And houses, this is house approvals. You can see that big surge we had through Home Builder in early 21, but now that's of course finished, though, that stimulus package, and we're back to a much more normal level of house building, and we're just not building enough, and it just means upward pressure on prices and rents, and it's really quite a simplistic proposition to make, and that's the underlying nature of Australian housing markets. So we'll have a quick look at the latest rental data. This is the January rental report, so it's fresh off the press. Vacancies are now low and still falling for inner city units. That was probably the one bright spot for tenants through the COVID period, and just after the COVID period is that we had relatively higher vacancy rates and less pressure on rents in the Melbourne CBD and in inner city Sydney. But that's reversing very quickly now. We're starting to see a surge in demand for those inner city units from tenants, and similarly in Melbourne. Increased demand, of course, will come from students coming into the market. And we're seeing falling supply because, particularly given that the Airbnb is now back to chasing those holiday tenants and business tenants. So they've taken their properties out of the long-term market. So increased demand and falling supply for units. But of course, let's forget all about houses, because you just can't rent a house in Australia anymore. It's just too expensive. And part of that, of course, is the shift to larger homes from the home office environment. But it really is a very sobering outlook for tenants. It's a sobering situation now for tenants, but the outlook is certainly not going to get any better. So Sydney still has the highest capital city rents in the country. We're seeing a narrowing between unit rents and house rents now across the board. Unit rents are now chasing house rents. Again, I mentioned it's the affordability scenario plus locational advantages. And of course, the growing appetite for unit living, apartment living, is driving demand. This is remarkable. This is the monthly rents. This is for January. Now, January is typically a quiet month for the rental market because it's holiday time, and you don't get as much as the shifting around in January. So we typically see an easing in rents and increased vacancy rates, but didn't occur in Melbourne and Sydney. We saw house rents continuing to rise in Sydney and Melbourne and Perth, and also unit rents rising again in January. This is quite sobering. Excuse me. This is quite sobering. I'm sobering. This is quite sobering data, because it shows that despite that holiday environment, that rents in Melbourne and Sydney are still rising, particularly in Melbourne for units. And there really is a rush into the Melbourne market for units, which was the most affordable rental market, particularly as a result of the lockdowns and impacting rental market. But hey, all bets are off now, and that Melbourne market is up and running in terms of demand for rentals. And it was always a short-term environment, those low rents in Melbourne, but they're certainly catching up very quickly now with the other capitals. Over the year, this is crazy stuff. Look how rents have risen over the past 12 months in all our capitals. Brisbane rents up 27.8%, which I guess validates what Sam was saying before. That's just an amazing result. And Sydney house rents up unit rents up 24.9%, and Melbourne unit rents up 20%. These are just amazing numbers to see this sort of growth in what is traditionally a subdued asset class over 12 months. Just shows the imbalances that were caused through COVID, and that the adjustment process is really well and truly underway now. And those numbers rising in Melbourne and Sydney are all about those inner city apartments that are being soaked up very quickly. No surprise again, well, surprise really, that we saw vacancy rates, and this is the absolute number, but vacancy rates actually fell in Sydney and Melbourne over January, and very low. These are basically says, well, we don't have any vacant properties. And the vacancy rates for units in Melbourne and Sydney have fallen sharply. The vacancy rate for a unit in Sydney is now similar to a house, and Melbourne has gone from near 6% vacancy rates to 1.5%, and falling month by month going forward. So great news for landlords. The pressure is on for tenants, unfortunately. And I think we're going to see some social consequences as a result of what is a locked out rental market. As I said, good news for investors with rents rising, and a product that is clearly in demand with no prospect of supply matching it anytime soon. So we'll have a look at home prices now. This is a bit of a history lesson quickly. I'm just going to alert you that after we look at what happened last year, we're going to have a look at what happened in January. Now, I've got a QR code, which is a connection to the My Housing Market January Housing Market Report. So get your cameras out, folks, because when it comes up soon, I'm going to give you about a minute to take a picture of it, right? Because we're all under the pump for time tonight. So I'm giving you a little bit of a heads up here. Get those cameras out and ready. If you take a picture of the QR code, it will take you to the report, which is the latest report, the January report on our capital city housing market. So what happened in 2022? Well, it was a housing market crash, wasn't it? Well, no, it wasn't. But it was certainly widely predicted. But again, those predictions were wrong. So let's have a look at annual house prices over 2022. So what we're measuring here is the December quarter 21 to the December quarter 22. Okay. So that's the annual price changes. So we're measuring like with like, excuse me, this is the annual scenario. So there was only two capital city markets that fell last year, and that was Sydney and Melbourne. So when we talk about it was an adjustment, well, it wasn't an adjustment in Brisbane, Adelaide and Perth. In fact, Perth was up by 6.9%. It was a downturn in Sydney and Melbourne. But when we look at the national result, of course, it was down 4.3%. So I guess the headline is house prices down 4.3%. Well, that's nonsense, because the national house price, and the national house doesn't exist, let me tell you. If it does, please show me where it is. But the national model, of course, is a weighted average based on the number of properties in each of the major capital cities. So what we do is obviously we take a weighted average based on the number of properties in each of the market. Now, of course, Sydney and Melbourne have way more properties than the other capital cities. So really, the national price is the Sydney and Melbourne price, if you know what I mean. So what we're talking about is Sydney and Melbourne. And you can see quite clearly, even though the national price was down 4.3%, there was no falling in prices in Brisbane, Adelaide and Perth. So I think that's an important clarification to make. So the other point that we had is that units outperformed houses, last year. The declines in Sydney and Melbourne were less than houses. But look at Brisbane and Adelaide. Brisbane up 11% for units last year and up 10.1% for units last year as well. Again, goes back to what Sam was saying about his project. So some very strong results there for units. But once again, the national unit price was down 4.2%. Hello, which means basically that's Sydney and Melbourne, where the vast majority of units, of course, are in Australia. So let's have a look at 2022 to put it in perspective versus 2021. So we can see how strong growth was in 2021 as against what we had last year. Again, the same measure, December quarter to December quarter. So it's all quite openly legitimate measures here. And I won't let you do the math in your head. I'll do it for you. So here we go. This is the aggregate over 2 years. So over the 2 years ending December 2022, the Brisbane housing market up 34.6%, Adelaide up 31.5%, Sydney up 23%. This is 2 years, folks, right? So, cha-ching, seriously. I think the interesting one here is the Melbourne market. The Melbourne market is the underperformer with the major capitals up 16.9%. Now, I think this really does show us the potential for growth that Melbourne has. We're already seeing that early days in January. And I think that's because of the severity of the lockdowns that Melbourne, suffered through COVID. And I think there's still a lot of pent-up demand in that Melbourne market that's ready to be released. And given the drive from migration on the demand side, as well as the pent-up demand being released, I think that Melbourne market's in for quite a positive year. But the 2-year results, hey, pretty good, seriously. So, I think you've got to look at things in a bit more of a longer term, have a bit more of a longer term view. And I mean, seriously, you reckon 2 years is a longer term view? Wow. If we go back 4 years, it's even more spectacular. But nonetheless, I think that puts everything into context in terms of what was, supposedly being a crash in house prices last year, not in the slightest. And even if we do use that national house price as a measure of, what's happening in our housing markets generally, it was actually the first decline we've had in the national house price since 2018. And it was only the fourth decline in annual house prices that Australia has recorded in the modern era. We've only had 4 years where house prices have fallen, and the worst result was 5.5%. These are calendar year results over in 2018. So we were around about where we were in 2008 and 2011 in terms of price declines, quite a moderate 4.3%. And as I showed before, it was really all about Melbourne and Sydney because the other capitals actually grew through 2022. So only Melbourne and Sydney reported price falls over 2022. Despite those falls, house prices in Sydney up 23.8%, Melbourne up 16.9%, but watch this space. Units outperformed houses for prices growth over the year. National house price down 4.3%, but it was the first decline since 2018 when prices were down 5.5%. And all those predictions of 10%, 20%, 30%, pick your number, of house price falls last year were once again well off the mark. And I believe that markets are set to record positive growth generally this year as rate rises ease and migration surges. So let's have a look at the latest data. Are you ready? Have you got your phones ready? So this is the January house price result, hot off the press, and we can see there that prices have. This is the national quarterly, the national rolling quarter. So it's the quarter up to January, and these are rolling quarters. So it's 3 months, but every month, and we can see there another but modest decline in house prices to begin the year. And of course, we have to remember, as with rents, that January is a distracted month. There are very low volumes of product in the market, and typically the product that is in the market is at the lower price spectrum. So I think this is a very good result considering at the January market. We can see when we look at growth rates that they have improved. The January is the gold there compared to the December quarter growth rate. So improvement there in Sydney, Melbourne, in terms of the rate of decline. Same in Melbourne, but going the other way in Adelaide and Perth. So, and the national house price actually trod water, marked the same over the January quarter compared to the previous December quarter. Annual growth again, Sydney and Melbourne are the underperformers. Other capital cities reported positive growth over the quarter, and these are the January quarter, and these are the median house prices. Units are still outperforming houses in terms of growth rates. You can see there that Sydney was actually above the line for units over in the January quarter, and Melbourne a little bit lower, and other markets are certainly showing some improvement there, but the Sydney one was quite spectacular with prices positive over the January quarter. And we look at the annual prices growth, again, Brisbane and Adelaide leading the way in annual prices growth for units. So these are the median unit prices over the month. I'm not going to go too much into the numbers, but the overall price report showed modest declines generally. House price declines east, Sydney, Melbourne, and with Brisbane steady. I think the Melbourne house price cycle is now close to the bottom, set for early year growth for houses. Positive unit growth in Sydney, and the unit markets generally continue to outperform houses. And I think overall an encouraging start to the year with price improvements despite the holiday market. Now there it is. Okay, you've got 60 seconds. Go for it. It'll work for you, Jason. Beautiful, mate. Hope you've all got your phones on you. And this, of course, is complimentary of Positive Real Estate. Just another goodie from, but courtesy of me. I think we're getting to the end of the 60 seconds, and we're going to finish a little early tonight, so that's good news anyway. So these are my fearless predictions for house prices this year. These are mid-level house price predictions for houses Canberra, Hobart and Darwin, around 4%. Brisbane, Sydney and Adelaide around 5%. I think there's some upward pressure there on Brisbane and Sydney. Perth up 7% with Melbourne. Again, I think that both those capitals have got potential for higher growth. But as I said, these are mid-price range forecasts. So this is sort of in the middle. But I think that the jeopardy lies on the upside. So they're more likely to be higher than lower. But they're all positive. And it will really only be the Sydney market on those numbers that won't recover what it lost in 2022. Units again outperforming, I believe. Houses again, Adelaide and Brisbane, the strongest there, up 8%. Perth, Melbourne, Sydney up 6%. Canberra, Darwin up 4%. Again, I think the Melbourne and Sydney unit markets have some upside to them. But let's not get carried away, folks. This is about, rational predictions. And I don't think I'm going to be too far away from the market at the end of the year. And this is a great result in a recovery year, given, what we went through last year. So we had the real latest data, which was last Saturday's weekend auction markets. This was the first real weekend of auctions. It is early days, of course, but it did give us our first real insight into what is happening on the ground at the moment in our housing markets. And if you can see here, auction clearance rates are a reliable forward indicator of house prices. This is the Sydney trend. You can see as clearance rates rise, house prices rise and vice versa. And it's the same relationship in Melbourne. So watch out for those auction clearance rates every Saturday. They're a great forward indicator of what's happening in the market. As you can see, they're a remarkable forward indicator. So last weekend was the first weekend of auctions really for the year. Reasonable numbers there in Sydney and Melbourne, mid-300s. But look at those clearance rates, folks. 70% in Melbourne and Sydney. And I think that shocked a few people. Remembering, if you look to the right there, where we finished off last year, and yes, we had more listings, but we were down in the 60% mark. So we're basically 10% higher from period to period. These are very, very strong results. Now, the same Saturday last year, we were in boom mode, and you can see how strong markets were there. But look how close Melbourne is now to where it was last year. There's only 2.3% difference in the clearance rate compared to where it was in that strong market a year ago. Again, I think this is validating, the future for the Melbourne market, and there's plenty of anecdotal evidence that that's up and running. But Sydney market as well. Brisbane, we had low numbers reported there, so we shrugged that one off. Adelaide still a strong market with 77%, and Canberra with big numbers for the beginning of the year at 58%. But I think this was a very robust result to start the year. It is early days. We need a couple more weekends to see if this is going to consolidate. But really, those, I guess those with a sense of optimism going forward wouldn't have wanted better results for the beginning of the year. And I think, as I said, these were just really quite remarkable results. But we wait for the next weekend, as we always do with our auction markets. So we can see the trend here in Sydney, how much ahead. And let me tell you, those Sydney and Melbourne clearance rates were the highest recorded since March 2022. So they're the highest. We haven't had a clearance rate that high, a weekend clearance rate that high since March last year. So it's got to tell you something, folks. That's the Sydney trend. That's the Melbourne trend. You can see how high Melbourne is compared to its previous 6 months. It's only one weekend, but nonetheless, Brisbane down. As I said, there was a low numbers of reported auctions. Adelaide around about where it's been, strong market, and Canberra also around about where it finished off last year. Look out for those auction clearance rates. every Saturday night on my LinkedIn account, and Sunday morning on LinkedIn, you'll get the full national auction report. So let's summarize everything before we get into question mode. Inflation outlook is improving. Let's also mention, when we're talking about inflation, that the US had its interest rate decision last week. It put up its rates by 0.25%. It's gradually started to track downwards with its interest rate increases, the US. It was pushing up by 0.75% at one stage there per month. So it's starting to think that it's coming to the end of its interest rate cycle. So the Reserve Bank will take note of that. And as I said, I think interest rates, and most are saying that now, will peak lower and earlier than predicted. I think we'll be up around about that 3.85% by the June quarter, and that might be sitting on your hands time for the Reserve Bank. It is a very fluid environment, don't get me wrong. It is very difficult to predict, but there are now early signs that higher interest rates are starting to work how the Reserve Bank wants them to work. But the whole point is that we have this remarkable booming economy. It is well positioned to absorb rates. I think the secret to our spring rebound last year in the housing market was the strong economy. Everybody's got a job, wages are rising, and people think, hey, I'm doing so well here. I'm going to get out and get that house. I'm moving on. I'm not going to believe all the gobbledygook about house price crashes. And I think that momentum is really shifting now into the new year. So house prices did ease through 2022, but decline levels improved over spring. Rising interest rates always constrain prices growth, and typically they impact confidence in the shorter term. But I really think that confidence hit was basically over winter, and people tended to shrug it off and move on. And all you got to do is look at those very strong retail sales numbers to see people are out there spending. They're still spending. They're getting the bigger wages, and they want to, take advantage of what are quite prosperous times. Yes, I know real wages are falling, but there are plenty of offsets for the higher inflation at the moment. Underlying demand, as we've said over and over, remains above supply. That reflects that recent underbuilding and the resumption of migration. Clear signs that price declines are easing sooner than predicted, as we saw with the latest January data, given that it is, typically the weakest month of the year, January, and it is the quarterly data that we looked at. So we look forward to moving into more substantial parts of the market. And I believe home prices are set to rise in all capitals this year, as I showed in that in my forecast. And those latest auction results certainly support rising confidence and activity through 2023. I don't know where the negatives are here anymore. We've gone through, a period of the first interest rate rises in, nearly 11 years last year. It was a bit of a shock to the system. Of course, all the, the nervous Nellies and the doomsayers were out in force telling us this was the end of the world. House prices were going to crash. They didn't crash. They were down in Melbourne and Sydney, but it was around about the same national decline that we've had recently, and we've only had 4 in the since 1987, which is a long time ago. So as I said, I think positives far outweigh the negatives, and I'm not sure what the negatives are, but we always have to be wary of what comes out of left field. We've seen COVID, we've seen inflation, but I think the prospects going forward this year are much more positive to continue with a consolidated recovery. Now, my message to finish off today is that misinformation and ignorance remain the curse of Australian housing markets. It keeps me in bread and butter, to be quite honest, because it's just too easy, because they're always wrong going forward, because they're seduced by the genie of clickbait, because there's no better headline than house prices will crash. We all want to read that one. But I think that those headlines are getting a little bit stale now. It's a little bit like the fable of the boy that cried wolf. Eventually it just gets ignored. And I think maybe it was getting ignored last year, into spring, and certainly it's getting ignored now. But of course, the key is to rationalise and act on all that fear that it generates. And by using, reliable data, reliable commentary, and those with a proven record in terms of, what their product is. And also, I think we could be quite aware of, the negative motivations for those that are always predicting those crashes. And what it means at the end of the day is there's nothing to fear. We talk about the housing market, Australian housing market. There's nothing to fear but fear itself, and even more so now because we're in a much more positive environment and a much more certain environment going forward. And I think the outlook, again, I'm going to say this, is for a much more stable, reliable housing market with, yes, prices, unfortunately, will rise. I mean, rents will rise, unfortunately, for tenants because they're not constrained by bank lending policies. But I still think the long-term growth levels will still be around 4 or 5% for properties net going forward into the future. But we just got to think about, well, what's going to happen going forward. But I think that the whole essence of property is there a better longer-term hedge against uncertainty? And I think the answer is no. And what I think is part of that, and I'm going to finish now, I'm getting into speech mode, but what I think is that we are really moving into a period where ownership of property, either as an owner-occupier or as an investor, is going to become a privilege. And maybe it's going to become an inherited privilege because we're just really starting to sideline opportunity going in. So, and this is just the nature of a product where there's just way too much demand and not enough supply. And that, I think, is the long-term outcome. So demand is ahead of supply. Confidence is rising. Moderating prices last year are now set to rise this year. So thank you very much for your attention. I think I'm right on the money in terms of my, in fact, I think I'm 2 minutes early. I think that's a first, isn't it? But we can, that's good because we won't be rushed for questions, and we can go back to